The Bank of England faces a crisis moment. Could its next move actually push the UK economy into recession? What you need to know right now. The Bank of England is caught in a difficult spot. Governor Andrew Bailey calls it the most difficult combination of economic challenges. The bank has kept interest rates steady for now, but faces increasing pressure to raise them. Yet, rising rates when demand is already falling could actually worsen the economic slowdown. This is because higher borrowing costs suppress spending and investment, accelerating the risk of recession rather than taming inflation. The bank's own analysis shows this is a known risk, not an unintended side effect. Unlike classic inflation driven by overheated demand, the UK economy currently faces suppressed demand. People and businesses are spending less, not more. Despite this, inflation pressures remain, partly influenced by external factors like the Middle East conflict impacting energy and commodity prices. The Bank of England acknowledges this unusual scenario where traditional rate hikes to cool inflation may backfire. Increasing rates in a low-demand environment risks deepening economic contraction rather than easing price pressures. In its latest decision, the Bank of England held interest rates steady, signaling caution amid complex conditions. However, the statement was clear: they remain ready to act if inflation continues to climb. This balancing act reflects the tension policymakers face. Act too soon and risk recession. Wait too long and inflation could spiral. Meanwhile, the European Central Bank also kept rates steady despite rising inflation, highlighting a broader global struggle among central banks. The Bank of England has highlighted how the ongoing Middle East conflict is impacting UK finances. Rising energy prices and supply chain disruptions feed into inflation and economic uncertainty. This external shock complicates the bank's job, adding pressure on an already strained economy. As policymakers weigh their options, these geopolitical risks increase the stakes of their decisions, with potential ripple effects on everything from household bills to business costs. Looking forward, the big question is whether the Bank of England will raise interest rates again. While some argue rate hikes are necessary to combat inflation, the risk of making an already fragile economy worse is real. If demand continues to fall and rates rise, recession's risks grow. On the other hand, failure to act could allow inflation to spiral. The bank's upcoming decisions in the next few months will be critical in shaping the UK's economic future. For you, this means uncertainty in borrowing costs, mortgage rates, and everyday prices. If the bank raises rates, loans and credit could get more expensive, but a recession could hit jobs and incomes. Staying informed on these moves helps you prepare financially. Hit subscribe now to stay updated as this story unfolds.